Okay. Okay. Good afternoon, everyone. I'm Tiffany McCoy. I use she, her pronouns. I'm the co-executive director with House Our Neighbors. We've run two successful ballot initiatives here in the city of Seattle to create and to fund a social housing developer. And I am also the board president of Washingtonians for Public Banking. We at House Our Neighbors believe in public banking for a multitude of reasons, but our intersection into public banking comes from the need for more options for housing finance. We know that right now, under the Trump regime, we cannot rely on the federal government to fund our housing needs. We have frankly been over-reliant on the federal government to fund our affordable housing needs, and we should be looking to more innovative tools here closer to home to make sure that we're providing the housing that is high quality and affordable to everyone in every income bracket. But right now, there's this huge moment I see across the political landscape nationwide. There's a resurgence, if you will, in public sector. Folks are interested in reviving public sector housing, public sector public works, public sector education, etc. But we know that ultimately, when you talk to lawmakers about whatever you are interested in, whatever you want to lobby for, they're going to say who's going to pay for it, or how are we going to raise the money, or who are we going to tax? So public banking is an option that we have available to us that has passed legal muster. Marco, whom I'll introduce in a moment, can get into this too in the Q&A or maybe during the presentation. But public banking is an option here in the state of Washington. It is an option at the county level or even at the city level. It's just a matter of political will. But we're really, really hopeful right now, even though it is a really dire time in our country, to tap into public sector, to make a public bank so that we can fund our housing needs, so we can fund public works, so we can fund a transition away from fossil fuels over to green energy, potentially to provide student loans. I mean, the possibilities really are endless. So that's why we, House Our Neighbors, are hosting this Lunch and Learn today with the Executive Director of Washingtonians for a Public Bank, because we want more financing options to create more housing that is there as a public good as opposed to a private commodity. So with that, I'm going to turn it over to Marco. But let me just do a really quick introduction. Marco is an organizer for Washingtonians for Public Banking. He's our executive director. He received a PhD in political science from the University of Illinois, Chicago. And throughout his years of public service, he has served on the board of several nonprofits and been active in the labor movement. So I'm going to turn it over to Marco, but please do know that we will have time for Q&A. Even though I'm the president of the board of Washingtonian for Public Banking, I'm not able to answer the highly technical questions about banking. Marco's your guy for that, but please do put questions in the chat throughout just so you don't forget it. And I will make sure to get to those at the end of this. And if there are bigger questions or folks are maybe interested in getting involved in Washingtonians for Public Banking, please don't hesitate to reach out or throw your email in the chat. We are looking to expand our board. We want to make sure that we're adding board members from around the state, not just, in the Puget Sound region. But right now, I know we all need something to look forward to and hope for. So with that, I'll turn it over to Marco, and you can take it away, Marco.
Well, thank you, Tiffany, for that great introduction. And before we go with this presentation and this discussion on the relationship between public banking and social housing, there are two caveats or things I would like to note. So the first off is that I am sure that in this group there is a ton of people who are very knowledgeable about the financing of affordable housing. So in that way, I have to admit, some humility with my presentation that it's a little bit like bringing coal to Camelot, because I know that there's a lot of great expertise, and I'm hoping that, especially during the discussion section, the question and answer section, those of you who do have a lot of expertise to educate me and the rest of the group about financing for affordable and social housing. The other part I want to emphasize is, as Tiffany alluded to, there is a really intimate relationship between public banking or public forms of financing and social housing. And as we've investigated this relationship deeper, it's really found out that the two are really reliant on them to both be successful. That's especially true in an American context where so much of our financial sector is the foundation of it is mortgages for real estate and housing. So we really hope to work with both people who are interested in having more public housing and have people having more public financing to encourage each other in the growth of these institutions. But without further ado, let's talk a little bit about some of the affordability crisis that we're having in King County, where House Our Neighbors is its home base, and how this affects the availability of affordable housing and why we need a social housing developer, and then how a public bank can support the mission of the social housing developer. So first off, just a few facts. Like I said, I'm sure that there are people who are very knowledgeable, have these memorized, but King County in general has experienced a massive housing shortage. It's the second most expensive county in the state to buy a home, and the median cost of a home in King County is over $900,000. Right. Now, added to that is the county must add 140,000 new units in the next 20 years just to keep up with growth. So that's just to maintain the status quo. That's not what we're hoping to do, is create a sufficient amount of units. We actually start to drive down the price and make housing more affordable. Now, on top of that, it does take about $350,000 to build a single unit of affordable housing in a multifamily building in King County. So it's very expensive to build a unit of affordable housing within the county. Now, I just want to review some of the different forms of affordable housing there are. So, one form of affordable housing is what's referred to as naturally occurring affordable housing. This is a form of affordable housing that just arises through market conditions. So, if you have an overproduction of units in your area, then the abundance of supply will drive down the cost of housing. Another form of affordable housing is rent-controlled housing. So this is some type of government body uh, dictates to landlords what they can charge with rent or how much they can raise rent within a given period. Another form of affordable housing is inclusionary zoning, where a municipality or a county government, if they have control over the zoning methods, they will provide for a developer certain exceptions to the zoning code to allow them to build more units on the condition that they set aside a certain percentage of those units for affordable housing, making sure that it's available for people who make under the area's median income. Then there's various forms of rent subsidies. We have Section 8 housing. States often give subsidies for people to support their rent. And then there are public financing tools, which is the main way we create affordable housing. And these include grants, some types of public housing, but the main one is the low-income tax credit, low-income housing tax credit, which the majority of affordable housing built in the United States is all dependent on the low-income tax credit. And then finally, the way we create affordable housing is through public social housing, where you have the government or some type of public nonprofit institution come in and build the housing and support and maintain it and treat it as a public good. Now, in terms of financing affordable housing, you basically have four different areas that you can rely on. One is you could just have cash up front. Or if you're a developer, you can kind of think of it as your individual equity for that building those units. Next is you could have those tax credits, those low-income tax credits, which are issued by the federal government down to state governments, and then they give those out to a way to attracting investors. And as if investors are willing to invest and give equity into that project, then they can get a tax break. All right. With that, intermediate client, that is, of course, equity. If you can find other investors who want to invest in the affordable housing project, you can raise the costs that way. And then finally, the last way you can get to build housing is through loans. You borrow it from a bank or some other financial institution, and you agree to pay it back based on the rents that are coming in. Now, as I mentioned before, the main way we fund affordable housing in the United States is through low-income housing tax credits. And this is a breakdown for California, but it's very similar to the rest of the United States. And as you can see, 43% of the financing for affordable and multifamily units comes
Marco,
from, yeah. Sorry?
Sorry, oh, never mind. Go ahead.
Okay. Comes from federal housing tax credits. And then another level, 11% comes from state housing tax credits. All right. So nearly half of all the financing for affordable multifamily developments comes from tax credits. And then we have some private bank loans, we have some federal home funds, we have some local funds, we have some funding from the federal home loan bank system, some state housing funds, and some state mental health services. But majority of the funding that we get for building affordable housing units comes in the form of these low income housing tax credits. Now, the thing about social housing is you do not want to attract equity because the point of it is not to divvy up the project to a bunch of private investors. You want to have a single entity, that's a government, put up the lending, put up the capital for the project. So tax credits are out of the question because tax credits are there to attract investors. You say, if you're going to invest in this project, we will give you a break on your taxes. So equity is out of the question and tax credits are out of the question. So to fund social housing, basically you have to rely on two sources. You have to have some type of cash or you have to borrow loans. You have to have some type of loans to build the housing that you want to create. Now, we can look at affordable housing compared to market rate to get an idea of how we work through relying on cash and loans. A lot of market rate housing is overwhelmingly determined by the initial cash or the individual equity the developer puts in, and then borrowing loans from the bank. As you can see from these two images, for a typical market rate housing, 60 to 80% of the project will be financed through loans. And the rest of it is the initial equity or the individual cash that the developer has on hand that they introduce for the project. Now, for affordable housing, it's a bit more difficult because banks are not interested in lending for affordable housing projects. Now, this isn't because affordable housing projects are not tend to default. The default rate for affordable housing projects tends to be very, very low, tend to be phenomenally low. And that's because you have a sense of what the rents are going to be, so it's easy to plan. The reason they don't like to do it is two reasons. One is that to make it affordable, you have to put out the loans for a very, very long period of time. All right. For a lot of the lending for market rate, you're talking about borrowing on a 5-year basis. For affordable housing rate to make it affordable, you have to do, 10, 15, 20-year basis to get back the loans. All right. So banks are not willing to do it. The other thing is, and we'll talk more about this, is that banks often sell their loans. A loan to a bank is an asset. It's something they have that they own that can make them money. So oftentimes banks will sell out their loans. And if there's not a robust market to buy a lot of loans that are affordable housing because the interest rates perhaps have to be lower to make the project economical, or they have to have a long payment process, it's not worth it for banks to make those loans because they can't resell it. So if we look at this image for the affordable housing capital stock, you have some equity that's provided by a developer. Then you have some debt that's provided by a banking institution, but you have this huge funding gap that you have to bridge. And normally that funding gap is provided by equity from other investors and low income tax credit. But as we find with social housing, that's not going to be the case because you want to keep the building to be a public building, so you're not going to attract private investors. You're not going to rely on low income housing tax credits. All right, so we have to find some way of bridging this gap so that we can still charge people reasonable rates for their building without having the entirety of the building be market rate. Now, with social housing, part of that is you charge some people, a bit, and you use their rents or returns to subsidize the people who can't pay as much. So that kind of gets into your equity. So you kind of build that up a little bit. But still, as you can see, that gap is still pretty big. So you need to find some way of having a secure line of credit to kind of bridge that gap. Now, I mentioned before that one of the reasons that banks don't like to lend to affordable housing projects is because a lot of banks sell their loans for their mortgages. That's part of our entire financial structure of our financial system. The whole reason we have Fannie Mae and Freddie Mac, those two government sponsored enterprises, is that they are designed to go out and buy mortgages from banks and then repackage them as mortgage-backed securities and then sell them to investors. Uh, the good side of that is the fact that they do that means that banks can increase their liquidity and increase their capital stock so they can go out and make more loans. So it increases the amount of money that is circulating through the economy. And if you have banks that are, providing loans for people to make mortgages, the more money they have, the more they can do that. So that's the positive aspect. The negative aspect of that is a lot of the loans that we have, they actually end up being owned by investors who buy those mortgage-backed securities. So if you're interested, and we'll discuss this more, if you're interested in keeping a project entirely public, it's very difficult to do that while relying on a private banking sector, because there is a good chance whatever mortgages you get, whatever loans you get, are going to repackage and then sent out to be sold on the market and then be owned by investors. And then if you ever default on the loans for whatever issue, the bank is going to claim that. And then it also could be whatever investor has bought those mortgaged backed securities. So what does social housing developers need? What do they need to really build a lot of units? Well, they need low interest rates for their loans. They need loans with long periods to pay back. They need loans that will cover a substantial part of the project. And they need loans that won't be securitized and be sent out to private investors. All right. So that's the type of institution you want. You want an institution that pretty much guarantee all these things. So let's talk a little bit about public banking and how it can work to guarantee these aspects. So this is a breakdown of the different types of banks that we have in our financial system. The majority of banks that dominate the market in our credit system are private banks. So a private bank is a bank that's owned by an individual or owned by a corporation, all right? If the purpose of a private bank is to maximize profits, either for whoever owns it or its shareholders, and majority of banks are corporations. Voting in the institution is determined by ownership. So if it's a corporation, if I have 30% of the shares, my vote is going to weigh more than people who have fewer shares, all right? But in the end, that institution is accountable to its owners, and they are there to maximize profits for those owners. Another institution is mutual banks, and there's very few mutual banks left in the United States. These are also private institutions that are profit maximizing, but how they distinguish themselves from other private banks is they are collective institutions. So everyone who buys into the mutual bank has the same amount of shares. It's across the board even, all right? So everyone has the same stake in the institution, and then everyone has the same claim over ownership and decision-making with the institution. And then we have credit unions. Credit unions are also private institutions. They are a collective private institution, but they are a nonprofit institution. The purpose of a credit union is not to provide, to maximize profit, but to provide financial services to whatever their membership is. And each credit union has a different way of defining what their membership is, what is the group they're going to serve. Because credit unions are run by a for-profit board, they are the membership is equal to them, and their board members act as volunteers. They don't have to be shareholders. They just oversee the governing of the institution, and in the end, they are accountable to their members. Now, a public bank is a public institution, meaning that it is owned or operated by some type of governing entity. Like a credit union, it is nonprofit. All right. Or if a public bank owns the majority of shares in a for-profit institution, that shares that it operates is also nonprofit. It can plow it back into the organization or it can use them for some type of public good. Now, in a democracy, a public bank is reflective of the values of that political system. So if a democracy has equal weight of citizenship, then everyone is equal in the decision-making process of that institution, and the public bank is accountable to the citizens, whoever covers the jurisdiction of that political institution. All right. Now, with that, we have to understand a little bit how banking operates. And initially, when we talk about banking, it's kind of counterintuitive for some people. One of the things that it takes a little while to kind of train our minds on is bankings operate as a perfect flip side, a perfect mirror to how we manage our own finances. So for us individuals, if we have a deposit in a bank, we get our paychecks, we deposit into a bank, that's our assets, that's our money, okay? And then if we take out a loan from a bank, that's our liability. We are obligated to pay the bank. Well, the bank has the complete flipped relationship. Deposits within a bank is its liabilities. And that's because at any one moment, a person could come and take out their deposit from the bank, and the bank no longer has that cash available. The flip side of that, though, is also its loans are its liability because the bank can say, hey, you owe this money, and there's never a dispute about you owe this money. The bank can defer to the political system, the judicial system, and say, this person owes me money. They're obligated to pay. And the courts will say, yes, this is the terms of the contract. You are obligated to pay that. So that contract has value because it's basically saying that I can extract wealth from you from the terms of this contract. So that's an asset for the bank. All right. Now, what makes banks so unique is their ability to engage in this process called fractional reserve lending. Now, what fractional reserve lending means is the banks will always lend out more money than they actually have in deposits. And the reason they're able to do that is because they know that only certain points of the transaction for anything that they are lending out to, they actually have to come up with cold hard cash to ensure that transaction is valid. All right. So if you go to a car dealership and you want to purchase a car, and the car is $50,000, very few people will have $50,000 in their pocket. They just buy it on the spot. Instead, they sit down and they do financing. They contact your bank and they get a loan. Well, the bank, what they do is they write a check to the dealership. So they don't need to come up with $50,000. The dealership then deposits it into their bank. They don't need the $50,000. They only need it at the point where the bank goes up to a check clearing service with the Federal Reserve and clears out the accounts. Then they actually have to transfer that money. All right. And because they're only need to come up with the money at certain points, they can lend out a lot more money than they have in reserves. A way to think about banking is if anyone's seen those old images of people kind of spinning those plates or juggling, that's basically what banks do. They juggle around money and they can ensure that as long as they have a certain percentage at hand and pay when they can keep juggling the money. Banks in general lend out on a 10-to-1 ratio. So for every $1 you have in your bank account, you can feel confident that whoever you bank with, if it's credit union, whatever, they're going to be making out $10 worth in loans for that $1 that of deposits. And again, that's fine as long as they're able to keep the juggling or keep the plate spinning. They can manage that. Now, in Washington State, we have this very unique institution called public development authorities. Our state constitution prevents a lot of governments from engaging in direct economic development. So to get around that, legislators have allowed county and municipal governments to charter these public-private institutions called public development authorities. Now, they're referred to as private institutions because they are separate from the institution that charters them. And they are denied certain capabilities that are traditionally reserved for institutions that are public institutions. Namely, they can't collect taxes and they can't engage in eminent domain. Because they're denied those capabilities, they can directly engage in economic development in a way that public institutions can't. However, they are considered a public institution because one, they're not there to maximize profit. They're there to serve some type of public good. And two, the governing structure of the institution is determined by whatever municipality or county charters it. And they have oversight, ultimate oversight over that institution. So it has some type of public oversight. Now, it is possible in Washington state to take a public development authority and charter it as a public bank. Just as up in Seattle, they have chartered a public development authority to be a social housing developer and go out and starting to build housing for the community as a public good. You could take a public development authority, charter it as a public bank, and then it could lend out for housing projects in the name of the public good. Now, that if you charter a public bank, that's only the first step as a PDA's first step. To operate a bank, you need basically three things, three major aspects. One is you need some type of banking license that is given by the state, or you can also have a federal banking license. The other thing you need is a source of capital. This is money that you have on hand to absorb any losses. For a private bank, what they usually do to raise capital is they sell shares in a corporation. If you're doing a public institution, you have to need some other creative ways to think of the capital. But for small banks, small banks or credit unions, you need to have capital that is worth 7 to 10% of your assets. For larger institutions, capital requirements can get very, very complex really quickly. Essentially, though, they're based on the risk of the asset. So certain assets that the bank has, remember assets is the lending, are not that risky. If they're lending to other governments, that's considered not risky. You don't really need any capital to back that up. But other things that are more risky, you need capital on hand to back that up in case there's any losses. And then finally, as we talked about before, you need deposits. You need some type of money on hand that you have to clear those transactions. All right. Now, you would get those things in Washington state, the banking license, by going through the Department of Financial Institutions. Like I said, you can get banking license on a state level. A PDA would have to appeal to them to get that institution. To do that, you have to prove to them you have a reliable deposit, you have a source of capital, and you have some type of business plan to make your public bank financially viable. All right. Now, we have done some analysis of the three major cities in Washington state to see if we could move some of their deposits from a public bank and what type of lending capacities that would entail. The city I think that you'd be most interested is in Seattle. At any one time, Seattle has about $3 billion sitting in a bank account. If that total $3 billion was moved over a public bank, that means that Seattle would have over about $30 billion in lending capacity that it could have for projects throughout the city. That would require a substantial capital to back that up. But even if it didn't do all $3 billion, it could do a portion of that as a deposit into a public institution, and then that institution can get underway of funding certain projects like social housing. This is further idea of sort of the complications of capital requirements. If you're a credit union, you can get away with 7 to 10% of it. Some way you could give even low as 6%. But if you're a small community bank, you have to have about 9% of your of backed up by your assets. As I said, capital requirements get very, very complex. So we don't need to go into all the details of it, but you can just really think of it in general. You're thinking at sometimes between 7 and 10% of your assets, depending on your charter and on all these other various factors that you need to back up for your lending capacity. But if you were to create a public bank, this is the road that you would have. You'd create a PDA. Then you would have to get some type of capital secured. Then you would have to get a banking license with the state. Then you would have to have a public deposit from the city moved over to the bank. And then finally, you would want to join the federal home loan bank system, which we'll talk about more, but that is a system that is sponsored by the federal government that provides increased liquidity to small banks to help them, especially if they're engaging in trying to make housing more affordable. Once you have all those elements together, you can start lending. Now let's talk about some of the financing patterns of various examples of social housing. Because as you'll see, nearly every type of social housing project that's been successful has some type of financing means of backing it. Now, I know that Montgomery County was an inspiration to a lot what's happened in Seattle. What County did to fund their projects is they created a revolving loan fund. Now, a revolving loan fund is similar to a bank in that it gives out lends, but it doesn't do any fractional reserve lending. So every dollar in is a dollar that goes out. But they did two bonds from their government that created this revolving loan fund that had $100 million. All right. And then they introduced a small tax, which they have to pay back those bonds. And that tax brings in about $3.4 million, and they can easily pay back those bonds. So what they do is that they give their social housing developer a series of loans. Social housing developer builds projects, but those projects have to start being able to pay back those loans on a 5-year basis. All right. So it's very conservative because it doesn't engage in fractional reserve lending, and the time frame they have it is only 5 years. Another example of financing for social housing is what they have in the Finnish system. All right, Finland has a very robust system of social housing. What they did is they created the National Housing Production Board to increase the amount of housing available in their communities. The ARP provides low interest government loans for the construction of new municipally owned housing. So all the new housing that's built, those are all subsidized loans for local municipalities to build housing. All right. In some cases, those subsidized loans comprise 95% of all the construction cost of the unit. And then they have very good terms for paying back those loans. And then finally, Vienna. Vienna has, a variety of mechanisms they use to help finance their social housing. So they have a public loan system that offers loans anywhere from 0 to 2%. So, bottom rate lending to cover the cost of construction. All right. Then they have private banks. They have private banks that gives out to their social housing developers, but the government comes in and subsidize all the interest on those loans. So the interest is lower than what you would have on the traditional market. Also, they have this other aspect what they call tenant equity, which allows potential tenants to give sort of these quasi loans to secure a space and then pay it back over time as part of their rent. All right. So there's kind of this patchwork system they've developed for all subsidizing the financing to make sure to build more units. So let's just talk about a little bit of what we could do if we had a public bank to support the social housing developer up in Seattle. So I've crunched some numbers just to give you some idea of this and made some assumptions. I will say that these numbers, they don't account for the cost of operations of the social housing developer. But I'm assuming that the social housing developer is going to have about $50 million to invest in projects. That those housing projects are going to cost about $350,000 to build. The interest rate on those and that the medium rent for paying back a project is going to be $1,300. All right. So if we kind of calculate that, $50 million, we have total $50 million based on the current rate, we can build 142 units within the first year. And then we have a rate of return on investment as people pay back those loans. That goes back into the capital stock. We have a new round of taxes come in with another $50 million. We add that to it, and we can slowly build up the amount of units that we build each year. And then the total units that we have after those 5 years is 777 units. All right. Not bad, but not a tremendous amount. All right. If we relied solely on just the money that's coming in from the excess compensation tax, about $50 million a year, and then rents coming in to compensate that. Now, let's think about this if we had a financing from a public bank. All right. And this makes the whole financing much more complex. So I'm going to walk you through it. But as you can see, we can dramatically expand the amount of units that you would have available. So what if instead of the $50 million going solely to the social housing developer, what if we gave a chunk of that to a public bank to help capitalize it? The city would then move over its deposits it has in the private banks to the public bank. And then the public bank would cover projects 80% of the cost. So the money that the social housing developer had would basically a down payment where the rest of the cost would be covered by the public bank. Um, if you do it that way, you can think of the money that's coming in from the excess compensation tax as a means of putting down a down payment on an issue rather than funding the project all in total. But this crunched some numbers. So we have $35 million coming in, $15 million from the total 50. We're going to have 35 to the social housing developer, 15 to the public bank. And then in the first year, we can give 175 million to fund a social housing project. That gives us 500 units just in the first year. So previous way we did 770 units in 5 years. This is 500 units within the first year. And then people start to pay back rents. They start to pay back those rents go to pay back the loans that the public bank gave to the social housing developer. And in that, because the public bank is having money coming in from paying back the loans, you can lower the amount of capital that was going through it each year. So the next year we lower it to $10 million and give $40 million to the social housing developer. We do that process again. The next year we can buy 578 units rather than just 500 units. So already we've blown past the amount of units we could create within 5 years. All right. We do it a third year where we lower the capital coming in from the excess compensation tax to 5 million, and we use it to compensate with those loans coming in. And then we can build 657 units. And then by the fourth year, you don't need to subsidize it. The total money from the excess compensation tax could all be going to the social housing developer. And then the funding that is supporting the bank is paying back those loans. And then after a 5 year period, you do that, you're now looking at, rough approximation, 3,221 units based on, assuming that the units are going to be $350,000, that the interest rates on loans are going to be 4.5%, and that the loans are going to take about 20 years to pay back. All right. So we've tripled the amount of units we can create through using a public bank, as opposed to just trying to fund the projects solely using the excess compensation tax. Now, I just want to talk in the last few minutes just a little bit about the Federal Home Loan Bank system and why it's so essential to be part of this and fulfilling the mission of the social housing developer and ensuring that it's going to be be a public institution. So the Federal Home Loan Bank system is it's basically a cooperative of banks that's supported by the federal government. The one that supports our area is in Des Moines, Iowa. It's the largest area out of all of them. And maybe question and answer, we could explain more about why that ended up being the case. But what they do, just like Fannie Mae and Freddie Mac, they provide liquidity to banks to engage in funding for housing projects. The difference is they don't buy mortgages off banks. What they do is they lend out to banks, but they say you can use the mortgages and your real estate as collateral for those loans. So the public bank, because it's being so anchored by a social housing developer, could then get loans from the Federal Home Loan Bank to add to even more lending, add to its capital supply to engage in even more lending, backed by the value of the units that the social housing developer has created. That is based on the loans that the public bank has given to them. As you can see, the Federal Home Loan Bank, they do have over 6,500 members. These members are all community banks, credit unions, community development financial institutions. Some saving institutions and insurance companies all become a part of this institution, are all dedicated to increasing the housing stock in the United States. This is just an explanation of how they make sure that they fund those banks by providing that liquidity for them so they can engage in more lending. And they are, they're not a well-known institution, but because they provide this extra liquidity, these loans to banks at very low interest rates to have them engage in more lending for housing, they've saved home buyers about $13 billion every year collectively. So these low interest loans really do add up for saving home buyers and allowing a lot more affordable housing to get out there in the market. Now, the last thing I wanted to touch on, though, is making sure that the social housing developer remains a public project and it maintains public jurisdiction over this. And we have an example of ensuring using a public bank to maintain a public project through the Bank of North Dakota. North Dakota is the only state in the United States that has a public bank. And during its history, which it was established in 1919, so it existed through its depression. During its history, a lot of the lending it gave out to small farmers, those farmers had to default on those loans because of the depression. Now, and if they did it to a private bank, or if the social housing developer took loans from a private bank and then there was a default, those loans would now become property. Those units would now become property of that private bank, and it no longer is a public institution because the private institutions own it. Well, if you do it to a public bank, it maintains to be a public institution, and that public institution is able to negotiate with you to maintain the integrity of the relationship of that loan. And that's exactly what the Bank of North Dakota did. It had a bunch of farmers who couldn't pay back their loans to the banks to help with their farms because of the Great Depression. What the bank decided to do in that situation is say, hey, we're not going to kick a bunch of people off their farms. Yes, what we're doing is we will foreclose on your farm, but we're going to have an agreement with you was you can stay on the farm as a renter and you will pay your rent to the bank because the bank owns your house. Then after a period of time, we will provide you an opportunity to buy your farm back at below market rate. So instead of ending up in the private sector, it stayed within the public sector. Well, if you had a public bank, you could ensure that for social housing. If the social housing developer ever got into trouble, due to ending lending, that wouldn't default to a private bank. It would default to the public bank. And if the public bank ever got in trouble, it would default because it borrowed and couldn't pay back. Those loans, remember, are assets that it borrowed itself from the Federal Home Loan Bank system. And it couldn't pay those back. Those would default to the Federal Home Loan system, which is a national credit union, which the public bank would be a member of. So that really insulates your assets from ever falling into private hands. And that kind of goes to two aspects of the charter for your own PDA for social developers. The housing must be owned exclusively by a public developer. Well, having a public bank ensures that to be the case. And developments must be permanently protected from being sold or transferred to private entity or public-private partnership. The public bank will protect you from that. It will provide a layer of public insulation so you can get that extra credit to build us more units while having to make compromises with the private sector. Okay. So that concludes the presentation. I know we have about 15 minutes left. I'm happy to answer any questions and hear all your comments about it.
Thanks a lot, Marco. Yep, lots to cover, but ultimately, we should not be investing our public assets into private banks that make a ton of money off of those public assets and then invest them in things that are not for the public good. So I'll pause here and open it up to any questions or comments. And yes, with such a highly technical topic, like please don't be embarrassed. If you miss something, you don't understand something, please do ask. That's what we're here for, okay? Yeah, Catherine, please go ahead.
Yeah, I just I was driving home while I was listening to his excellent presentation. Thank you. And I'm wondering, with everything that's going on, would and the public bank language has been in the legislature for a while now. Would could it potentially be passed by our legislators in January?
So the thing is, you don't have to wait for state legislatures with this.
Oh,
That was the beauty of a public development authority.
okay.
What you could do, just as you created a public development authority for your social housing developer, you could create a public development authority for a public bank. And then once that's established, you can have that bank be anchored in providing financing for your social housing developer. What you would need, though, is if it was chartered by the city of Seattle, like the Public Development Authority is, you do need cooperation from the city to move over its deposits and to make sure to
Right.
apply for the banking license and work through all the regulatory infrastructure. But once that's established, you don't need to worry about the state legislature. You can go around it if you have the support within Seattle to do this. And then again, it's a lot of benefits to anchoring the project in the social housing developer, because that the public bank can supercharge the amount of units you can create. Just my estimates. Like I said, you can do nearly 4.5 times as many units in the same time period because you're putting so much of it on credit. But it's very secure credit because you have an idea what the rents are going to be. We know that there is a huge housing shortages. We're very unlikely to overbuild and get ahead of our skis. The default rate for affordable housing, which is the closest thing we have for research to measure for social housing, even though it is a little different, is extremely low. So it really makes a lot of sense to anchor this institution as a social housing developer because it's guaranteed to be pretty successful.
Oh, okay. Well, that's awesome. So basically, we just need to make sure that Katie Wilson is voted in as mayor and we get as many city council people, right, as possible.
That's it. Or you could just, you could go around the council like you did with the social housing developer
Uh-huh.
and run a referendum.
That's so much work and so much time. It'd be easier to just get the right people voted in, don't you think? Or it'd make more sense. People think we love to be out there collecting signatures, and that's just like we got all kinds of other things we'd rather do. Anyhow.
Thank you, Catherine. You see that one in the chat from our friend Guy. How do you get the startup assets for the bank, given that you need 6 to 9% of assets to deposit?
So yes, the one of the hurdles of the bank is that you have to come up with a source of capital. So in my model, I just assumed that the excess compensation tax, that initially part of it would be shared with the bank. And again, you only have to do that for a period of time because once the loans are going to be paid back, the bank can add that to its capital stock. So it doesn't have to occur every year. If that is distasteful to people, if they don't think that's is the right way to go, you have to come up with some other source. So you have to introduce some other new tax. You have to take it out of the general fund. Another way you could do it is sometimes people look at moving pension funds over, or the city participates in the state's local investment pool. They can move funds from there to the public bank. But you do have to be honest and be aware that you need some type of way of capitalizing the bank. All right. So, but as long as you can come up with that initial capital, you're all set. And like I said, you only have to have that for a period of time because once those loans are being repaid, that goes to the bank's capital stock, and the bank should be self-sufficient.
Just one more thing on that one. Yeah, and Guy, feel free to follow up if you have deeper questions about that. But yeah, just like Marco and we are laying out the path that has been legally vetted, that is possible and what it could fund. But every step along the way is a big process, and it's something where we would need a lot of public momentum, elected legislative momentum, and a movement to push for this to happen. So it is completely possible, but it will take, Marco, unless you disagree, a couple of years for this
It could
to
take a couple of years.
actually get up and running. Yeah.
Yes, because you need to get approval. You need to get approval from the bank license from the state. You would need to get FDIC insurance, and um, I think there are questions if with Trump being in charge of the FDIC, if there was to be any shenanigans, if they thought this was, if they wanted to punish, a Democratic state, um, then you would have to uh, get an assurance from the city to move some of its deposits it currently has in private banks over to the public bank. Then you would have to get a letter of credit to collateralize those deposits. Then you'd have to join Federal Home Loan Bank as a member. So, short timeline, it could take up to a year. Long timeline, it could take more than 3 years, or even more than that. So you have to be realistic about the time frame. So all those things would have to go and explain into and be prepared for it. There are some things you could do though to still have the project be off the ground. Like you could start the bank off as a revolving loan fund in the interim while you're getting the licenses and all the approval to actually engage in the fractional reserve lending. So you can it's still worthwhile to get the project off the ground and have parts of it active until you can get the rest of it all up and running.
All right.
Next question, Marco, is would you anticipate any legal challenges from private equity?
Not necessarily private equity. I think it is possible that you could have a legal challenge to the bank, but I think the law around this is pretty secure because public development authorities, a lot of them already engage in lending. That's not so common in Western Washington because a lot of the public development authorities are there for urban renewal. And so they, kind of act like as landlords are trying to redevelop an area. But in Eastern Washington, a lot of the public development authorities are there to support small businesses because they have so many few means of economic development. And a lot of those institutions already engage in acts of lending. Now, they don't necessarily engage in fractional reserve lending, but there really isn't any reason to say that a public development authority couldn't engage in fractional reserve lending. So I think there would be a very strong arguments to support that to battle any other legal challenge. There is also perhaps a more legal argument that's a bit out on the limb that you could that it might be worth to reach out to if there was a lot of legal challenges, and that is the Washington Constitution. If there's anything funny about engaging in economic development, they do have some requirements to say it's absolutely okay. One is that if it's for the poor and infirmed. Now, if it's engaging in social housing, you have a pretty solid argument there. You help out the poor. Two, if it's a government to government lending. Well, if the PDA is lending out to social housing developer, that's also to another government entity. So that's pretty secure. And then three, if it's for some type of essential government service. And the courts have been kind of considering that housing is kind of an essential government service. Also, there are some legal arguments put forward where people have argued that it makes sense to treat money as infrastructure. Like there's a famous essay with money as infrastructure that says money and credit should be kind of considered would be equivalent to like a public infrastructure. And so you can kind of consider it essential government service. That's why it's so regulated and we have all these bodies over it. So you could make a compelling case to the Washington Supreme Court is that we should consider money as essential government service. And that's why, we can have a public bank. So there's a lot of different ways we could, secure this institution against any legal threats.
Thanks, Marco. Last question before we wrap up. It's a comment into a question. I also agree the question of private equity is super important, especially since public pension funds are the major investors in private equity. Is there any beneficial role for pension funds to interact with the public bank, such as purchasing deposit certificates, for example?
Yeah, I mean, the public bank, of course, wouldn't have any equity because it's a nonprofit institution. But what if private pension funds wanted to help out a public bank, especially on the state level? What they could do is loan out their pension funds as capital to the private bank, and the bank could say, "Hey, we will promise to pay you back whatever returns you would have got if leaving your, if the money was left in the pension fund rather than moving it over from capital. We will pay you back and then some, and that'll help get off the public bank get off the ground. Outside of that, though, there's not really anything else to do because again, a public development authority doesn't have equity. It's but by law not to have any type of equity, so you couldn't invest in it like you could in another public bank. But you could provide the initial capital with a promise that you would be pay it back.
Okay, like that was a quicker answer than I maybe thought. Guide, does that answer what you were getting at, or do you want to probe a bit more? Yep, that did.
Okay.
Okay. All right. Well, Marco, any final words before we sign off today?
Uh, I guess I just wanted to emphasize that again, as I said at the top of the meeting, that this really does seem to be a very happy marriage between housing and banking. And as you can kind of see, if the social housing developer can get a secure access of financing, you can really supercharge the amount of units that you can produce. You can really move it up, a tremendous amount. And so I really hope that this is pursued as supporting this overall project of supporting social housing, because you would not only create an institution that could transform the housing market in Seattle, but it really could transform the overall economy. The Bank of North Dakota, which is the major institution that we all point to, that bank has an asset of about $10 billion. So it's just about the size of a community bank. If Seattle was to move over its entire deposit to a public bank, again, that could be a potentially more $30 billion. So could be 3 times as large as the Bank of North Dakota, which would make it by far the largest public bank in the United States. Granted, there isn't a lot of competition there, but still, it would have a tremendous transformative effect for the city and the state.
Thank you, Marco. Appreciate it. And thank you, everyone, for joining us. If you have any further comments or questions, please don't hesitate to reach out to us. Thank you for joining us this Tuesday afternoon. Bye.
Bye.